Hello, this is Jordan, and this is your Precious Metals Video Market Update. Today is Thursday, December 24th, 2015, Christmas Eve. Starting off, let's look at a daily chart of gold, and looking at the short-term outlook here, you see there's a double bottom there. I mean, we've talked about what double bottoms look like, what they don't look like. This looks like a double bottom as far as the very short term in this daily chart. I mean, the reason is because you see a test of 1050, rockets up to nearly 1090, then comes back down, and then two strong days going from 1050 up to 1080. So that's typically what a double bottom looks like. You see two lows at the same level, but the moves coming off each of those lows are pretty strong. And so what we'd look for as we move into 2016 is we think gold has a good chance here to get above this 1080 to 1090 resistance and trade up to, I would say, at least 1118, which is the 50% retracement. Now, depending on how you measure this double bottom or W type pattern of the last month or so, you can get a target as high as 1130 or as low as 1120. So conservatively, I'd say 1120. The 200-day moving average is at 1144. It's declining, so that looks like it could continue to decline, maybe come down towards or to 1130, 1135 in the next month or so. So assuming gold is able to power through 1090, then it should be able to get to 1120 in my opinion. So that's what I'm looking for here over the next month. Of course, if I'm wrong and the market fizzles out, then 1050 is your support, with 1000 being your next strong support. But I'm reasonably confident that we're going to see gold move higher over the next month. Now, let's keep the big picture chart in mind. That's the monthly chart for gold. I know some of you are probably sick of me talking about it, but on the monthly chart shows that gold continues to have heavy resistance just below 1150, probably around the 1120 to 1140 level, but 1140 especially is where that strong resistance is. Then of course 1150 and 1180, but we already know that, and we know that gold made a low of 1045. It's come off that to the upside nicely. The low coincided with nearly the 2008 high and the 2000, I believe that is the 2010 low at the very beginning of 2010. I could be wrong. There's also strong Fibonacci targets around 1040, so that's why gold was able to rally from the area. But the much stronger targets again are 970, which is a 50% retracement from the 1970 low. And you can see there that there's strong monthly support in that area, and then also 890, which is the 62% retracement of this entire bull market run, and it is the 1980 peak high. So big picture, short term over the next month or two, we think gold can rally, but then it's probably going to see selling pressure as we move into the second quarter, and perhaps we could see an end to the bear market if in the second or third quarter, if gold is able to have a successful test at 970, or perhaps even a bit lower than that if we get some kind of a spike low. But if that were to happen, I think it would happen very quickly. Now, if you've been reading my writings in the last month or so, I've been talking about how the gold stocks were showing relative strength. They didn't make new lows, and then I've been showing a lot of different charts here why I think they're in position to rebound. This is another reason. This is the updated gold stock bear analog. No matter what index you look at, this is the worst bear market ever for gold stocks in terms of price, and it is the second longest ever. It would have to go past the end of February, so more than another 2 months, and it would be the longest ever, in addition to being the worst ever in terms of price. And I mean, not to get off on a tangent, but Fed policy over the last 20 years, I mean, what it's really creating in the capital markets is really extreme moves in both directions. I mean, just look at stocks. I mean, you have the huge technology bubble in the 90s. Then you have, I believe, the two worst bear markets in stocks basically since the Great Depression. And yet, coming off of that, we have this huge recovery and a great bull market over the last 6 years. So you're just seeing these extreme moves in both directions. And also, I mean, we see the same thing with gold and commodities. I mean, there was the 2008 decline in commodities. I mean, I think the worst ever in commodities in terms of price, and now we're seeing another severe bear market in commodities. But commodities had a great bull market in the last decade. So Fed policy is really creating extreme moves in both directions, and so it wouldn't be a surprise if we see a massive bull market in the gold mining sector in the years to come. I mean, I think there's a good chance it's going to happen, and just the long-term risk for where we are right now in mining stocks is extremely low. But you have to buy the right stocks, and I'll comment on that more on the next slide. But this is GDXJ, which looks like it's leading GDX. This is a daily chart. Light week this week. I mean, a holiday week. It's creeping higher. Maybe next week or in January it pulls back a little bit, but whether it does or doesn't, I think over the next month you're going to see GDXJ rally to at least 22, maybe that red line, which is just below 23. If you go back to the highs in late 2012 and you draw a trend line connecting those highs and then the highs in summer 2014, that comes down to the end of January at just below 23. So we're not showing you that trend line, but there is going to be some resistance at 22, 23 over the next month or so for GDXJ. And if you look at the bottom, I have GDXJ against gold right now. That's 0.186. I mean, that has resistance at 0.02. If that gets to 0.02, which it looks like it will, and you have gold get to 1120, which is kind of my conservative target, that would put GDXJ at I believe 22.4. So just that also coincides with the 22 to 23 target I just mentioned. Now, if we see that ratio break out above 0.02, that would be an indication that perhaps we could see a bigger rally. And while I'm not predicting that scenario right now, the target for a bigger rally would be 25.26. That would coincide with the 400-day moving average, which, I mean, if you look at the last 5 years in GDX or GDXJ, 400-day or 80-week moving average, they both have been major, basically bear market resistance. So that's something to keep in mind if this looks like a very strong rally. And if you look at the rallies that GDXJ had following the late 2013 and late 2014 lows, I mean, these were very strong rallies. We're talking, I think, about 40% and 50%. I mean, a 40% rally from 18, you're looking at a move up to 25-ish. So if the miners can duplicate the rally that they had starting last year and the year before, then GDXJ could break above 22 to 23 and rally all the way up to 25-ish. And just the last point on the mining stocks, you really got to be a stock picker. I mean, obviously that's something I emphasize in my service. I mean, you can trade the ETFs, but I think there's certain companies that I think have already bottomed, and you're starting to see them outperform. And those are not small producers, but larger, junior, mid-tier type producers that they're in the right jurisdictions where they're benefiting from weak currencies. They have large production. They don't have any debt, so they're benefiting from weak local currencies, and they're also benefiting from the huge drop in fuel costs. And in addition to those types of companies, I mean, junior development stage or development companies with late stage projects that are basically in the permitting phase or very close to nearing production or shovel ready status. I mean, the companies that have those larger assets that show really strong economics at $1,100, $1,200 gold, bigger type projects, those are the ones that I think are really going to lead Areas that I don't think are going to lead, assuming that we see an end to the bear market this coming year: exploration type companies, silver companies. Those would be the areas that I would avoid. I don't think they're going to lead. If you look at you go back to the 2001 bottom, silver, even though it bottomed in 2001, it really lagged for another year or two. It didn't really start to outperform for a couple years. The same can be said of a lot of exploration companies. So those are areas that I'm personally avoiding. We're working on an update to our book. So we've given the book away for free already. Go to thedailygold.com/book. If you're still on our list, then we are going to send you the updated version of the book when we get done with this update. That's all for today. If you want to follow more of my work, you can go to thedailygold.com, opt in for my email list. If you have any comments or questions, feel free to email me, jordan@thedailygold.com. Thanks everyone for listening and watching. I wish you all a Merry Christmas and a Happy New Year, and I look forward to doing another video update in the next week or two.